Welcome to the Deep Dive. We're here to sift through the noise, pull out the key insights from important sources, and basically give you the shortcut to being really well informed. And today, we're diving into something that's making waves in global finance, something that, frankly, might make you look twice: the US dollar, the long reigning king of currencies. Well, it's had its weakest start to a year since, get this, 1973, since the end of Bretton Woods. It's down about 7% on a trade-weighted basis since January 2025.
Yeah, that 7% figure, it really jumps out.
It does. Now, some people might just say, oh, it's a blip, the dollar always bounces back. But is this wobble different? Could it signal something, more fundamental?
That's exactly the right question to ask because, historical context is everything here. Dollar corrections, sure, they happen. But our sources are really pointing to some distinct factors this time around, factors that seem to be chipping away at global trust, at liquidity, in ways we haven't quite seen for decades. We're really talking about vulnerabilities that seem to be cropping up under President Trump's second term.
Like what specifically?
Well, things like erratic tariff policies. They create huge uncertainty for global trade, right?
Yeah.
Then you've got these ballooning fiscal deficits, which cast a long shadow over the U.S. economy's long-term health. And maybe the sharpest point: repeated threats, public threats against the Federal Reserve's independence.
Ah, okay. Politicizing the Fed.
Exactly. And when the world's benchmark currency starts looking less stable, less predictable, maybe even subject to political winds instead of, sound economic policy, well, nations have to sit up and take notice. They really do.
Okay, let's unpack this then. What does a weaker, maybe less predictable dollar mean for you listening right now and for the whole global financial picture? That's what we're here to figure out. Our main focus today is China's stepped-up campaign to, rely less on the US dollar. And tied to that, the yuan's, the renminbi's surprising, though maybe volatile, gains in global trade. So this deep dive, we're going to explore China's strategy, all the different moves they're making. We'll look at the role of the BRICS group, which is getting bigger and louder. We'll touch on the digital yuan. That's a whole other frontier. And of course, we have to talk about the real roadblocks, the structural hurdles that are still very much in the way of the yuan becoming truly international.
Right. And our mission, really, for you, the listener, is to cut through those big, splashy headlines you see about de-dollarization. We want to analyze whether we're actually looking at what some in Beijing call an epic opportunity for the yuan to, mature into a proper global currency. Or perhaps are these just smart strategic moves in certain niches, part of a much longer game, maybe leading towards what you might call monetary pluralism.
Where multiple currencies kind of share the stage.
Exactly. Or maybe even something a bit more tense, like a monetary Cold War, a real competition over financial standards, payment systems, that kind of thing. We'll try to lay out the different views, the data points, give you that full, nuanced picture.
Yeah, that's the goal. We're hunting for those aha moments, the connections that help you understand what's really shifting in global finance and why it matters, because it does matter everywhere. It's a complex game board out there, and we want to hand you the map.
Okay, so let's dig back into this dollar wobble. You mentioned it's down 7% since January 2025. And that comparison you made to the 1970s, the end of Bretton Woods, that really does make you pause, doesn't it? It highlights how significant this could be.
It really does. I mean, the 1970s, that was a period of huge upheaval in global finance, a massive reordering. And the sources we're looking at, they explicitly draw that parallel. This weak spell for the dollar, it's not happening in a vacuum. It comes after the markets have had time to digest these pretty big tariff shocks and, just a general climate of policy uncertainty coming out of Washington. That makes global investors, very twitchy.
So it's more than just the number, the 7%.
Yeah.
It's the why behind it. Precisely. Beyond the headlines, the specific factors are key. You've got these repeated, sometimes seemingly impulsive, changes to tariff policies. That throws international supply chains, trade deals, everything into disarray. Then there's the relentless growth in fiscal deficits. Even for the U.S. eventually, that raises questions about long-term debt sustainability. Can they keep borrowing like this? And then, back to the Fed, those threats to its independence, that's like a direct hit on the perceived impartiality, the reliability of the institution managing the world's #1 currency.
Right.
Put those together, and it erodes trust. It impacts liquidity. It makes even the mighty dollar seem less stable and maybe crucially less reliable as that neutral bedrock.
It's almost like, you're on this giant, super stable ship, the USS Dollar, that everyone relies on. And suddenly the captain starts, randomly changing course, yelling at the navigator, maybe throwing some cargo overboard. Even if the ship itself is still fundamentally strong, you start questioning the voyage, right? Definitely the captain's judgment.
That's a great analogy.
So how might this perceived instability, even if it turns out to be temporary, because let's face it, the dollar is incredibly resilient, how might that act as a kind of psychological trigger, nudging other countries, other institutions to seriously start looking for or building alternatives?
Oh, the psychological impact is huge. You can't really overstate it. Think about it from the perspective of other countries, other central banks. For decades, they've relied on the dollar. Its stability, its deep liquidity, that's been the assumption. But if you start seeing consistent signals of instability, or worse, unpredictability, well, that forces you to consider diversification much more seriously.
It becomes a risk management issue.
Exactly. It shifts from just being about, say, yield or efficiency to becoming a matter of strategic national security. The perception that the dollar could be, weaponized through sanctions, or that its value might swing based on political decisions rather than economic fundamentals, that creates a really powerful incentive to find other options. You mentioned those stung by sanctions and extraterritorial rules. Those countries feel this vulnerability most acutely. They're actively looking for ways to insulate themselves.
Okay, so while the dollar's been doing this unsteady dance, what about the yuan, the Chinese currency? Our sources say, by contrast, it actually rallied, hit its strongest level against the dollar since Trump's re-election back in November 2024. And Beijing officials are apparently calling this an epic opportunity to push the renminbi, the RMB, towards maturity as a global currency. Now, that sounds like more than just trying to score some economic points, doesn't it? It feels bigger.
Oh, absolutely. It's far more than just an economic play. Beijing does see this as an epic opportunity.
Mhm.
Yeah, people outside China might hear epic and think, okay, bit of hyperbole there, especially given the dollar's deep-rooted strength.
Right. What's the data backing up the epic claim beyond just a short-term rally?
Well, the key insight here isn't just the yuan's appreciation attracting some investors or exporters for purely economic reasons. For China, this is fundamentally about strategic sovereignty. It's about de-risking from a system dominated by the dollar. You have Pan Gongsheng, the governor of the People's Bank of China, the PBOC. He's repeatedly highlighted the risks of being over-reliant on a single sovereign currency. He's explicitly warned that Washington's ability to, as he might put it, weaponize the dollar through sanctions, through control of payment systems like SWIFT. Well, that exposes the entire global economy to unnecessary instability.
So they're framing it as a global stability issue, too.
They are. Beijing isn't just passively reacting to dollar weakness. They're actively using this moment, this perceived vulnerability, to try and reshape the global financial order. They argue that a more diversified system with multiple major currencies would create financial checks and balances, making the whole system more resilient. It's a very calculated push for greater financial autonomy and, let's be frank, greater global influence.
So China's basically putting its cards on the table, saying, we intend to challenge the status quo. But given the sheer weight, the inertia of the global financial system, how feasible is this really? Is it more talk than action?
It's definitely not just talk. There's real action behind it, which we'll get into. But you're right to point out the inertia. The dollar system is incredibly entrenched. However, the long-term implications, even if the shift is gradual, are profound. If China manages to successfully build and institutionalize a viable alternative network, even if it doesn't fully replace the dollar, that alone could lead to a much more fragmented, more multipolar financial system.
What would that look like?
Well, it might reduce the bite of dollar-based sanctions, for one. It could empower countries that want more distance from U.S. foreign policy objectives, and it would fundamentally alter global trade and investment flows. You'd see economic power become more diffused. Now, that could mean more complexity for global businesses, definitely, but it might also offer new ways for countries to build resilience against unilateral financial actions. So it's less about a hostile takeover, maybe, and more about establishing a credible parallel track. But even that would dramatically shift the global power balance over time.
A credible parallel track. Okay. So this epic opportunity naturally demands an epic strategy from China. They're not just sitting back waiting for the dollar to stumble. They're actively playing a multidimensional game, a kind of financial grand strategy to boost the yuan globally. Let's lift the lid on their playbook, starting with the basics, pushing for more yuan use in trade and finance.
Yeah, their efforts are definitely multi-pronged. It's trade, it's finance, it's technology. And the main vehicle for boosting yuan use in trade settlement is their cross-border interbank payment system, CIPS. Think of it as Beijing's alternative to SWIFT. And the growth numbers there are pretty eye-popping. In 2024, CIPS processed something like 175 trillion yuan. That's roughly 24 trillion US dollars. And
Wow.
that was a 43% jump year on year. A huge leap. Now, this isn't just about moving money around. China is systematically building out this parallel financial highway. And the real insight, I think, is that as more foreign banks, now over 1,500 of them, especially in the Global South, plug into CIPS, they're not just finding an alternative to SWIFT. They're actively normalizing yuan-denominated trade.
Making it seem less unusual, more routine.
Exactly. It slowly chips away at the dollar's dominance in transactions, payment by payment. It creates this self-reinforcing ecosystem outside the traditional Western financial rails. And we saw it in the first quarter of 2025, about 31% of China's own foreign trade was settled in yuan. That's getting close to its all-time high. It shows the trend.
Okay, that 43% jump for CIPS, it sounds massive. But if we dig a bit deeper, what's really fueling that growth? Is it mostly, say, trade with sanctioned countries like Russia finding a workaround? Or are we seeing broader, more organic adoption from other economies, too? Because the source mentioned Russia, didn't it? Conducting most of its China trade in yuan now because of Western sanctions.
That's a really important distinction to make. And yes, sanctioned nations definitely play a part. Russia is the prime example. Their almost complete switch to using yuan for China trade is a stark illustration of how weaponization, or the fear of it, drives adoption of alternatives. For Russia, CIPS and the yuan became a lifeline. But if we connect that to the bigger picture, China isn't just building this for Russia. They're building parallel plumbing, a clear alternative for any country that feels vulnerable to dollar-based sanctions or pressure.
So it's about providing options.
It's about providing options, redundancy, a way to de-risk from the U.S.-dominated system. It's not necessarily about replacing SWIFT entirely tomorrow, but offering a credible escape hatch. And beyond CIPS itself, they've done other things. They've set up 31 offshore yuan clearing banks in 27 different countries. That makes it physically easier for foreign companies and banks to handle yuan abroad. They've also tweaked policies, like allowing qualified foreign investors to trade more yuan-denominated commodity futures, things like natural rubber, tin. And they can use foreign currency as collateral.
Making it easier for commodity exporters.
Exactly. It makes settling yuan more attractive for nations rich in commodities. They can earn yuan directly and then use it directly without needing dollars as an intermediary. Plus, you see major foreign banks like Standard Bank in South Africa, First Abu Dhabi Bank in the UAE. They're joining CIPS. That signals growing legitimacy, growing acceptance beyond just China's close geopolitical allies.
Okay, so that's the traditional trade and finance side. But then there's the digital yuan, the e-CNY. That sounds like a completely different ballgame, potentially much more disruptive.
It really is a whole new frontier. The digital yuan is a key pillar of their strategy. It represents both a big technological leap and potentially a fundamental shift in how cross-border payments could work. They've done extensive domestic trials, as you know. But now, Beijing is planning an international operations hub in Shanghai, specifically to push the e-CNY for cross-border trade finance. They're also testing yuan-linked stablecoins for exporters. That offers a way to bypass dollar rails entirely, potentially slashing settlement costs.
So it's not just about convenience then.
Not at all. It's profoundly about sovereignty. It's about providing an alternative payment system that operates completely outside the existing U.S. dollar infrastructure. Remember Russia getting kicked off SWIFT? That sent a shockwave. It really highlighted the potential for weaponizing the current system. The e-CNY offers a state-controlled public digital rail. It doesn't rely on private banks or intermediaries in the same way. That gives China potentially unprecedented control and reach in payments.
And are there actual international tests happening already? I think you mentioned Project Enbridge. Sounds like it could be significant for central banks.
Exactly. Project Enbridge is a really interesting one. It involves the central banks or monetary authorities of Hong Kong, China, the UAE, and Thailand. The goal is instant cross-border settlement directly between these central banks. And they've already processed over $20 million in test transactions. It shows the real potential for central bank digital currencies, CBDCs, to make cross-border payments much faster, cheaper, and more sovereign. You cut out layers of correspondent banking, the costs, the delays.
So here's the question then. If these digital currencies can really slash settlement times and costs so dramatically, how disruptive could the e-CNY become, even if it doesn't totally replace the dollar?
That's the key question. It probably won't replace the dollar anytime soon. But it fundamentally shifts the leverage. It creates a credible, sovereign alternative that dramatically lowers the cost and friction of bypassing dollar rails. That gives nations a real option they never had before. It changes the geopolitical financial calculus. And we're also seeing this tech regulatory contest heating up, right? The U.S. is moving to normalize dollar stablecoins, while Beijing pushes the e-CNY and explores its own stablecoins. This digital money space could be the sharpest front, the most active area of competition in this whole monetary shift in the near term. It's not just about which currency, but whose tech, whose payment rails, whose standards will prevail.
So alongside building these new systems, CIPS, e-CNY, China's also using policy levers, kind of nudging things along, making the yuan a more standard choice, at least within its own economic orbit.
Precisely. It's not just about building, it's about encouraging usage. Authorities have been consistently, let's say, leaning on major Chinese banks and state-owned enterprises to increase the share of RMB they use in their cross-border business.
But top-down push.
Definitely a top-down mandate. To normalize it, institutionalize yuan usage within China's huge sphere of influence. Make it the default choice. They've also expanded the menu of RMB-linked financial instruments. We mentioned letting foreigners trade more commodity derivatives. They've also created these bond connects, making it easier for foreign investors to access China's domestic bond market. And these nudges seem to be working, at least domestically. In March 2025, the RMB share of China's own cross-border payments hit a record 54.3%.
More than half.
More than half. That shows a real concerted internal push to make the yuan the go-to currency for Chinese entities dealing internationally. But, these domestic efforts and bilateral deals only get you so far if you want global impact. For that, Beijing needs allies. It needs broader coalitions. And that brings us squarely to the growing power and the clear agenda of the BRICS bloc.
Right. So China's sharpening its own tools, building its own infrastructure. But no major global shift happens alone. Beijing clearly gets the power of working together, and that's where this expanded BRICS group really enters the de-dollarization story. They bring some serious geopolitical weight, don't they?
They absolutely do. It's an increasingly powerful force. Remember, the expanded BRICS now includes Brazil, Russia, India, China, South Africa, the original five, plus Egypt, Ethiopia, Indonesia, Iran, and the UAE.
That's a big group.
That's a huge group, and it shows real accelerating momentum towards using alternatives to the dollar. De-dollarization is high on their agenda. Some reports suggest that around 90% of trade within the BRICS bloc is already happening in local currencies.
90%. Wow, that's up from what, 65% just a couple of years ago?
Exactly. A massive jump in a short time. And why does this bloc matter so much? Well, together they account for nearly half the world's population.
Half the population.
And roughly a third of global GDP. That collective economic weight means their initiatives, their push for de-dollarization, carry significant heft. It makes their actions really hard for the rest of the world to just ignore.
That is a staggering shift, nearly doubling local currency use within the bloc so quickly. And it's not just about using their existing currencies more, is it? They're also talking about building new platforms.
That's right. It's about building alternatives. There's the proposed BRICS Pay platform, for instance. The idea is to create a system specifically to bypass SWIFT, allowing direct currency exchanges between the member countries, sort of like CIPS, but for the whole bloc. And then you have the new development bank, the NDB. That's BRICS' own multilateral development bank. It's increasingly issuing loans in the local currencies of its member countries. That's crucial because it offers an alternative to the usual dollar-denominated development finance from institutions like the World Bank or IMF.
Providing funding without the dollar strings attached, essentially.
That's the idea. So the key takeaway for you listening is that BRICS isn't just tinkering around the edges. They are actively trying to construct a kind of parallel financial universe for their members. The goal is to make them less vulnerable to external financial pressures, particularly sanctions originating from the West. And in doing so, they effectively weaken the power of those unilateral sanctions. It's about creating redundancy, resilience.
But the sources also suggest it's not all smooth sailing within BRICS. Alignment isn't perfect, and there's no talk of a single BRICS currency coming anytime soon. So there's a collective push, but individual interests still matter.
That's a really important nuance, yeah. It often gets glossed over in the headlines. Alignment within BRICS is uneven. India, for example, is quite cautious. They don't want to completely undermine the dollar system because they have vital trade and strategic relationships with the U.S. they want to protect.
So it's a balancing act for them.
It's a definite balancing act. So while there's this shared desire for alternatives, you're right, there's no BRICS coin on the horizon, and it's not like the Eurozone project. The real practical focus is on improving the payment pipes, making direct currency exchanges easier and faster. Which then leads to interesting questions, like about Saudi Arabia. Their potential membership has been discussed, though it's not fully formalized yet.
Right.
How might bringing in a key oil producer like Saudi Arabia impact these de-dollarization efforts? especially in energy trade, the heart of the petrodollar system. Their involvement could give a significant boost to using the yuan, or maybe other currencies, for oil transactions. That would add a whole new layer of complexity to global energy markets and the dollar's traditional role there.
Okay, so a BRICS provides a collective push, a platform. But the actual adoption story, especially for the yuan, really comes down to individual countries, individual transactions, which brings us to the current reality check. Where does the yuan actually stand globally right now? Because the numbers, they seem to jump around quite a bit, don't they? A bit of a roller coaster.
They certainly do. And sorting through that volatility is key to understanding China's real progress or lack thereof. Let's break it down across a few key areas. First, SWIFT payments, the traditional measure of global currency use. The yuan share actually slipped back to around 2.9% in May 2025. That was after it had climbed to number 4 globally, hitting about 4.1% in March-April. Then by June-July, it was back down to number 6, around 2.88%.
So up and then down again. What does that tell us?
It's telling, and it prompts that question. Why do we see these fluctuations? Why the gap between, say, fairly high trade settlement within China's own sphere, but relatively low global reserve holdings, or these jumpy SWIFT shares?
Yeah, what do those peaks and valleys imply?
Well, the SWIFT volatility suggests that while yuan usage does spike, often linked to big geopolitical events, tariff news, sanctions headlines, times when countries are actively looking for alternatives, the underlying depth and liquidity of the yuan outside of China and Hong Kong is still pretty thin.
So usage is event-driven, not necessarily deep-rooted yet.
That seems to be the case. It gets boosts, but it's not necessarily sustained, broad-based organic adoption across all sectors all the time. The data also shows, from independent trackers, that maybe around 30% of China's goods trade was settled in RMB by the first half of 2025. That's definitely higher than before the Ukraine war, but interestingly, still below the peak it hit back in 2015.
Okay. And what about the ultimate measure of trust, how much central banks hold in reserves?
Right. That's often seen as the gold standard for a global currency. And there, the yuan's share of global foreign exchange reserves is only about 2.1 to 2.3%. And notably, that's actually down from its peak of 2.8% back in 2022.
Down, despite all the push.
Down slightly. Compare that to the US dollar, which still commands around 58% of global reserves. The euro is around 20%. So the yuan is still a very small player in global reserves. And even looking at portfolio flows like foreign holdings of Chinese bonds, they're significant, around 4.4 trillion yuan, maybe $610 billion. But those holdings softened mid-year. Why? Low relative yields compared to elsewhere, and persistent geopolitical caution among global investors.
Okay, so putting all those numbers together, the jumpy SWIFT share, trade settlement below its peak, reserves actually dipping slightly, cautious bond investors, it paints a picture, doesn't it? It seems like niche gains rather than broad dominance, making inroads maybe, but definitely not a takeover.
That's exactly right. The data strongly suggests that the trade use of the yuan, particularly within China's orbit or with specific partners, is rising faster than its adoption as a global store of value or reserve asset. It highlights the yuan's progress in specific niches trade with sanctioned countries like Russia, building out cross-border payment infrastructure like CIPS, especially appealing to the global south. But it also underscores the significant limitations it faces in becoming a truly broad-based global reserve currency, or a safe haven asset like the dollar or even the euro. Think about the scale. China is about 18% of global GDP, maybe 15% of global trade. But the yuan, still only involved in maybe 2–3% of international transactions globally.
Compared to the dollar's, what, 60-something%?
Around 66% for the dollar, maybe 20% for the euro. The gap is just enormous. And that gap, that disparity, really brings us to the core reasons why. The significant structural hurdles the yuan still needs to overcome. These aren't just minor issues, they're fundamental obstacles.
And those structural hurdles, they're precisely why the dollar, despite its wobbles, remains king. For now, anyway. The first big one you mentioned, capital controls. That feels like a cornerstone of how China manages its economy.
It absolutely is. Capital controls are fundamental to their system. Beijing maintains pretty tight restrictions on money flowing across its borders, both in and out. Why? Primarily to prevent destabilizing capital outflows, which could wreck their domestic financial stability, and to maintain control over their exchange rate. But while that gives them domestic control, it severely limits trust in the yuan and internationally. Full convertibility, the ability to move money freely, is key for a global currency.
Because investors need an exit strategy.
Exactly. Reserve managers, global companies, big investors, they need absolute confidence that they can not only put money into RMB assets, but also get it out easily, quickly, without sudden political interference or getting tangled in red tape. The current controls make the yuan much less attractive as a true global reserve currency, where liquidity and free convertibility are non-negotiable.
Mm.
And what's fascinating, as you pointed out, is the inherent contradiction here.
Right.
China wants the yuan to be international, but it seems unwilling to give up the very capital controls that often define its domestic economic management.
Mm.
So an investor might look at Chinese bonds, see a decent yield, but then worry, what if tensions flare up? Will Beijing suddenly clamp down and stop me from taking my money out?
Yeah.
That uncertainty, that political risk overlay, is often enough to keep big money parked in dollars, despite the dollar's own issues.
Okay, beyond capital controls, there's also the issue you flagged as institutional opacity and the rule of law. That sounds like a deeper, maybe more systemic challenge.
It is. Absolutely. Concerns about legal transparency, about whether contracts will be reliably enforced, about the potential for political interference in the legal system.
Right.
These things significantly reduce the willingness of international players to hold large amounts of RMB assets for the long haul. Think about the dollar's biggest advantage, its deepest moat. It's not just the size of the U.S. economy. It's the trust in the underlying institutions, the relatively predictable rule of law, the deep, liquid financial markets built on that foundation, especially in the U.S. and its close allies.
Trust in the system itself.
Exactly. Trust in a predictable, transparent legal environment where disputes are resolved based on law, not political whim, is absolutely crucial for international finance. Investors need to know their assets are secure, contracts will be honored, property rights are protected. So you have to ask, how much does perceived government intervention, or maybe a lack of clear judicial independence, deter foreign investment, even if the yields on offer in China look attractive on paper? Without that fundamental trust in the legal and governance framework, widespread adoption as a global reserve currency is incredibly difficult. It just introduces a layer of political risk that many international asset managers simply aren't paid to take.
And this ties into another point. China's own policies sometimes seem contradictory, don't they? Pushing the yuan globally, but also actively managing its value domestically?
Yeah, absolutely. That's another key tension. The government is simultaneously trying to promote the yuan's international use while intervening heavily in the currency market to manage its value. We saw an example in June 2025. Chinese state banks apparently bought up $47 billion worth of foreign currency. Why? To prevent the yuan from appreciating too strongly, even as China's trade surplus hit a massive $115 billion that same month.
So they're actively working against their own currency, getting stronger.
In that instance, yes, because a yuan that's too strong could hurt their exporters' competitiveness and potentially disrupt domestic financial stability if inflows become too large or volatile. But that kind of intervention directly undermines the idea of a free-floating, market-driven currency. It makes the yuan less appealing for international players who want predictability and market-based signals.
So here's where it gets really interesting, as you said. They want the yuan to be global.
What?
Not too global, not too strong.
It certainly looks that way sometimes. It's this very delicate balancing act. Their domestic economic priorities, controlling inflation, maintaining export competitiveness, ensuring financial stability, often seem to override the requirements of becoming a truly international reserve currency, which demands a more hands-off, market-led approach. That inherent conflict, that strategic limitation, is something most other currencies aspiring to a global role don't face quite so starkly.
Okay, and finally, overlaying all of this, we can't ignore the dollar's own massive advantages, especially what you called its network effects. It sounds like a system that just reinforces itself.
That's an excellent way to describe it. The dollar still possesses unmatched liquidity, meaning ease of buying and selling large amounts without moving the price. It has perceived stability despite recent wobbles, and just incredible depth in its financial markets. That makes it the default safe haven. When global crises hit, where does money flee? Still overwhelmingly to the dollar. And these powerful network effects create this self-reinforcing loop. Because everyone else uses dollars, you want to use dollars too. It makes transactions easier, cheaper, lower friction.
The path of least resistance.
Precisely. And look at the U.S. Treasury market. That's a $25 trillion market for safe, easily traded government debt.
Yeah.
There's simply nothing comparable anywhere else in the world, certainly not in China's bond market yet. So in crises, investors flock to dollars in U.S. Treasuries. The yuan just can't fulfill that global safe haven role yet. We saw that clearly during the initial COVID shock, for example. And then there's the geopolitical layer. The U.S.'s vast military power, its global alliances, its influence in international institutions. All of that subtly underpins confidence in the dollar-based system. It provides a sense of security that contracts will be enforced, trade routes will remain open. So if you connect all of that, The dollar's dominance isn't purely economic. It's deeply intertwined with trust, with institutional depth, with stability, and yes, with geopolitical power. That creates a truly formidable barrier for any challenger.
It really does feel like this huge gravitational pull, doesn't it? Even when things get shaky, the instinct is still to gravitate towards the dollar. You see it everywhere.
It's a deeply ingrained psychology built over decades, hard to shake quickly.
Okay, so those hurdles, capital controls, rule of law concerns, policy contradictions, dollar network effects, they're clearly significant. But China isn't trying to conquer the whole world overnight. They seem to be strategically targeting regions, specific partners that are more receptive to alternatives, particularly in the global south. This makes the global south a really key battleground, maybe the key battleground in this whole monetary shift. The stakes there seem incredibly high.
Indeed, they are. For developing countries across Asia, Africa, Latin America, the global south dollar dominance is this strange mix. It offers both stability and intense vulnerability. On the one hand, having access to dollar liquidity is crucial. It's needed for trade finance, for paying for imports, for accessing global capital markets, even for holding as safe haven assets in their own reserves. It provides essential stability. But on the other hand, it exposes them massively. They're vulnerable to shifts in U.S. monetary policy they have no control over.
Like Fed rate hikes.
Yeah, exactly. The Fed raises rates in Washington, and suddenly borrowing costs shoot up for countries from Ghana to Indonesia. Their dollar-denominated debts become much harder to service. They're also exposed to exchange rate shocks if their own currency weakens against the dollar. And as we've discussed, there's the constant background threat of sanctions, of being cut off from the dollar system via tools like SWIFT.
So what does this mean for the global south? As you said, it really is a double-edged sword. Offering critical access, but also carrying significant risks they're increasingly desperate to mitigate.
Precisely. They feel the downsides of dollar dominance very acutely, which makes them much more open to exploring alternatives than, say, developed economies in Europe.
And this is where BRICS comes back in, right?
Yeah.
Leading the charge, offering a collective way forward for these nations.
Absolutely. The expanded BRIC bloc, remember, nearly half of humanity, over a third of global GDP. That sheer scale gives their collective actions real weight. And their push to settle trade in non-dollar currencies is accelerating. That 90% figure for inter-BRICS trade, if accurate, is remarkable. It shows a clear collective effort to build redundancy, create options. You see Russia's pivot to the yuan post-sanctions. You see India experimenting with rupee dirham settlements with the UAE, that's huge, bypassing the dollar for major energy trade.
Settling oil deals outside the dollar.
Exactly. These are prime examples of building parallel systems. Which really brings us back to that question. Are these BRICS nations genuinely creating a robust long-term alternative? Or are they mostly just reacting defensively to immediate pressures, to geopolitical realities, trying to build resilience against dollar weaponization? It's likely a mix of both, isn't it? A powerful combination driven by a shared desire for greater economic and financial autonomy.
And within the global south, Africa seems to be emerging as a particularly interesting space. A quiet but maybe crucial testbed for a lot of these de-dollarization experiments.
Africa is definitely a key arena to watch. China's trade with the continent is enormous, over $280 billion annually. And increasingly, more of those flows are being settled directly in yuan. This is actively helped by China setting up those offshore RMB clearing banks we mentioned in Nigeria, South Africa, Kenya. They make it technically easier for African businesses to use yuan. And then there are African initiatives too, like the Pan-African Payment and Settlement System, PAPSS. It was launched under the African Continental Free Trade Area. Its whole purpose is to allow cross-border payments within Africa to happen using local currencies, cutting out the need for dollars as an intermediary.
Reducing costs and reliance.
Exactly. For African nations that are often starved of dollar liquidity, these alternatives, whether yuan-based or using their own currencies via systems like PPSS, can genuinely lower transaction costs and reduce dependence on external currencies and policies. But there's always a but, isn't there? This also inevitably ties them closer to China's economic orbit, raising those familiar concerns about swapping one form of dependency for another.
Okay, so in this shifting landscape, particularly across the global south, countries are navigating these new options, these new pressures. Who stands to win? Who might lose out? And what are these new dependencies that could emerge?
It's definitely a mixed picture, with clear potential winners and losers. Potential winners. Commodity exporters, for sure. Think Angola, Brazil, maybe Russia. They benefit if they can invoice their exports in their own currencies, or maybe yuan, reducing their foreign exchange risk. Sanctioned states like Russia and Iran obviously gain vital lifelines. Yuan or ruble-based settlements allow them to keep crucial trade flowing when dollar channels are closed. Even smaller African economies could potentially win by accessing cheaper financing through RMB-denominated loans or by saving costs using local currency settlement systems like PS, bypassing expensive dollar conversions.
And the potential losers.
Well, countries already burdened with heavy dollar-denominated debt face a double whammy. Think Argentina, maybe Ghana. They have rising dollar liabilities, but the alternative systems might not yet offer enough liquidity or stability. They're caught in the middle. Import-dependent economies could also face challenges if they can't easily access yuan or other alternative currencies, or if those currencies are volatile. And crucially, there's the risk for Global South borrowers that they simply swap dependence on Washington and dollar-based institutions for dependence on Beijing and yuan-based financing.
Trading one master for another, potentially.
That's the concern some observers raise. So what's fascinating is that while these countries are striving for diversification, for greater autonomy, they face this very real risk of replacing one dependency with another, particularly reliance on China's growing economic and financial influence. And the geopolitical angle is stark. For Washington, dollar dominance has been a key tool of foreign policy leverage for decades. For Beijing, promoting the yuan is about de-risking its own economy from potential sanctions, yes, but also clearly about asserting leadership and influence on the world stage. This creates obvious tensions. You see India being cautious about letting the yuan become too dominant regionally. You hear concerns in Africa about potential debt diplomacy linked to Chinese lending. It's complex.
It really is. All of this complexity, these competing forces, it strongly suggests the future isn't about a simple switch from dollar to yuan. It sounds much more like what some are calling a monetary Cold War, or at the very least, a much more fragmented, pluralistic system. The ground really feels like it's shifting.
It absolutely does. And the most likely destination, according to most experts we're drawing from, isn't a world where the dollar is suddenly dethroned. It's more likely a world with, let's call it, thicker multipolarity.
Thicker multipolarity, meaning
Meaning a currency system that's still dominated by the dollar, but with more significant roles for other currencies in specific regions or functions. And a system that's probably more politically fragmented than today. In this baseline scenario, you'd see RMB use continue to inch up, particularly in trade settlement within Asia or with BRICS partners, and usage of CPOs would grow. But SWIFT shares might ebb and flow, reacting to geopolitical events. The dollar would likely stay dominant in global reserves, maybe still around that 55–60% mark. The euro stable around 20%. And the RMB would grow, but incrementally, maybe nudging up from its current 2–3% towards, say, 5% over a longer period. Meanwhile, things like Project Enbridge pilots would expand, more RMB clearing banks would come online, building out that alternative infrastructure slowly but surely. So this view suggests it's not a zero-sum game, not replacement. It's more a gradual transition towards coexistence, a balance between multiple currencies, each finding its niche, its areas of influence.
Okay, so within that broader trend towards multipolarity, you mentioned three overlapping arenas where this competition is playing out, almost like fronts in this monetary Cold War. What are they?
Right. The first arena is simply invoicing and settlement and trade. Here, we should expect to see more regional trade being settled in local currencies. So more RMB in Asia and with Russia, maybe more use of the Indian rupee in South Asia, perhaps more dirhams or rials settling trade within the Gulf Cooperation Council. This will be especially true where the risk of sanctions is high, pushing countries to actively seek out and use non-dollar options. SWIFT's overall share might oscillate as companies react to headlines, hedging currency exposures back and forth.
Okay, invoicing and settlement. What's the second arena?
The second is the financial plumbing competition. Think CIPS versus SWIFT. Now, it's not really a simple head-to-head fight. CIPS actually still uses SWIFT messaging protocols for many of its transactions, which shows how entrenched SWIFT is. But the real focus here is on building redundancy and interoperability. Things like Project Enbridge, linking central bank digital currencies, or creating instant payment linkages between different countries' domestic systems. This will likely continue to fragment the global payment system. That might mean more operational complexity for multinational businesses, definitely. But it also adds resilience for countries and companies who can now choose from multiple payment routes. It's about building optionality, having alternatives ready.
Makes sense. And the third arena, that sounds like where the really cutting-edge, potentially disruptive action is happening, the digital frontier.
It absolutely is. The third arena is the digital money race. This is where things could change fastest. If yuan-backed stablecoins gain traction internationally, or if the e-CNY itself finds real cross-border use cases, maybe starting through Hong Kong as a gateway, then the whole debate about payment rails becomes as much a technological and regulatory contest as it is a purely macroeconomic one. You've got the U.S. trying to get its arms around regulating dollar stablecoins, making them safer and more integrated. At the same time, Beijing is pushing the e-CNY and exploring its own digital currency innovations. This becomes a race about whose technology is better, faster, cheaper, whose regulatory standards will prevail, whose digital architecture will underpin future global payments. This digital front is probably the sharpest edge, the most dynamic area of competition in this whole monetary shift right now. Innovation here could really accelerate the changes we're talking about.
Looking ahead then, say over the next 12 to 24 months, what are some plausible scenarios we might see unfold in this evolving monetary landscape? What could speed things up or maybe solidify the current situation?
Well, beyond that baseline thicker multipolarity we discussed, you could imagine a couple of key scenarios. First, a stress case. Imagine another major sanctions event, maybe targeting more countries or sectors, or perhaps another big tariff shock from a major economy like the U.S. That kind of jolt could instantly push companies and maybe even some central banks to actively hedge away from relying solely on the dollar. You might see a temporary spike in RMB usage in SWIFT or CIPS data as entities scramble for alternatives they've been building. But importantly, those underlying structural issues we talked about, capital controls, rule of law concerns, would likely mean that portfolio flows, the long-term investment money, would probably remain cautious. So it's a spike in transactions, but maybe not deep trust.
Okay, that's the stress case. What about an upside scenario for the yuan?
An upside tail scenario would involve China taking concrete steps to address those structural hurdles. Imagine if Beijing genuinely loosened capital controls, even just at the margins, making it easier to move money in and out. Or if they significantly improved legal predictability for foreign investors, maybe established clearer rules or greater judicial independence for commercial disputes involving foreigners. If that happened, you could see global reserve managers starting to feel more comfortable. They might slowly, cautiously increase their RMB allocations, maybe from the current 2-ish% towards something like 5% over time. Now, 5% still wouldn't unseat the dollar from its dominant perch, not even close, but it would significantly institutionalize multipolarity. It would make the yuan a more broadly accepted, albeit still secondary, reserve asset, a real structural part of global financial portfolios, not just a niche player.
So wrapping this all up, what's the bottom line? It really sounds like the future of global money isn't this dramatic winner-take-all battle, but something much more nuanced, a gradual shift towards coexistence, maybe?
Exactly. That seems to be the most likely trajectory. We're definitely not witnessing a clean overnight regime change in global finance. The dollar isn't collapsing tomorrow. What we are watching is the world's financial plumbing becoming more diverse, more complex. More channels are being built. CIPS, bilateral swap lines between central banks. We're seeing more digital rails emerge, the e-CNY, various stablecoins, experiments like Project Enbridge. And critically, we're seeing more politics embedded in money itself. Currency choices are becoming strategic choices, sovereignty choices. So it looks less like a hot war, maybe more like a long, grinding Cold War over financial standards, over settlement systems, over sovereignty. It's a future where the dollar likely remains dominant overall, but the yuan and potentially other currencies or systems keep carving out important niches. Niches that matter strategically, economically, especially for countries actively seeking alternatives to the dollar's pervasive reach.
This has been a genuinely fascinating deep dive. Really helps to connect the dots on a complex story. Let's quickly recap the key takeaways for everyone. We started with the dollar's recent wobble, its weakest start to a year since '73, fueled by policy uncertainty and fiscal worries in the U.S. This created what China perceives as an epic opportunity, China's response. An aggressive multi-front strategy, pushing trade settlement via its CIPS system, pioneering the digital yuan, e-CNY, and leveraging the expanded BRICS bloc to promote collective de-dollarization. But while the yuan has made real gains in specific areas trade with certain partners, digital payments, its overall global adoption remains limited. Significant hurdles persist. China's own capital controls, concerns about institutional transparency and rule of law, policy contradictions, and of course the dollar's massive entrenched network effects.
And that leads us to the most likely future. Not outright replacement of the dollar, but growing multipolarity. The global financial landscape is clearly fragmenting, diversifying. That creates new challenges, yes, more complexity, maybe new dependencies, but it also creates new opportunities for nations and businesses seeking resilience and autonomy in a changing world. It demands careful strategy from everyone involved.
We've seen how geopolitics, economics, and now technology are all intertwining to reshape global finance. But this leaves us with a big question, maybe for you to ponder after listening. If the world does continue moving towards a truly multipolar currency system, what will the outcome be? Will it actually create greater stability through more checks and balances between competing currency blocks? Or could it lead to increased financial fragmentation, more complexity, making global trade and investment ultimately harder, riskier?
It's a crucial question. Remember Pen Gongsheng, the PBOC governor, argued that a balanced competition among currencies is the foundation of financial resilience. But what does balanced competition really look like in practice? Does it foster healthy cooperation and global stability? Or does it imply a future of constant jostling for advantage, new forms of interdependence, and maybe new spheres of economic influence replacing the old ones? It's something worth thinking about.
Absolutely. This deep dive has really only scratched the surface of an incredibly dynamic and important story. We definitely encourage you to keep following these trends, especially the race in digital currencies and the evolving role and cohesion of the BRICS group. Thank you so much for joining us on the deep dive today. Until next time, stay curious.